Hello, hope everyone's doing well today. Here's our learning session for the week, Invest for the Long Term, and what that means. You can always save my contact information is www.planwithbob.com. If you want to look me up via a mobile device and easily save my contact information, go ahead and go to www.planwithbobinfo.com. Okay, let's go ahead and get started. Let me show a couple disclosures here, just to keep the compliance department happy here. Okay, well, let's take a quick look here at this graph here. Stocks have compounded a very attractive 9.5% annually since the 1900s. Even though you can't specifically invest directly in the Dow, this is a very attractive potential return over time, and it highlights attractive potential of long-term investing. So take a moment here and take a look at what the market has done over time. Now, stocks have historically risen much more often than they have fallen. Based on rolling monthly time periods since the 1950s, the S&P 500 has risen on a price basis, excluding dividends, 92% of the time over a 10-year period and 100% over 15 years. Over shorter time periods, gains are less likely, but still much more likely than not. Really, the key takeaway here is stay invested, especially in volatile markets. People get scared. There's lots of emotions, but again, the past does not predict the future. Past results aren't indicative of future results by any means, but this is just something to kind of give you some historical content, or context, I should say. Market time can be costly. Missing the market's best days can be extremely detrimental to your portfolio. If you take a look here in regards to 1990 to 2021, right? If you miss just 5 of the best days between that time period, you would have had a negative 4.1%. 20 best days missed, negative 24.4. Again, reiterating the fact, stay invested. It's very important. This Dalbar study estimates the average investor achieved far lower returns during 21 years ending in 2020 than a basic buy and hold strategy would have achieved in various equity asset classes. The message here really is that individuals that aren't experts and are actively trading accounts can lead to lower returns over time because emotions can get involved. In a mid-cycle economy, recession fears do not typically cause stocks to fall in a given year, nor do stocks typically surge as investors celebrate emerging from the prior recession. Now, over the past 60 years, the S&P 500 index was up an average of 11.5% during the 30-year cycle years that we were able to identify. Now, with gains in 80% of those years. As you can see in this graphic, stocks rose during most of these mid-cycle years, with 1966 and 1977 being the only 2 years with double-digit losses. Okay, next slide, please. Now, volatility is normal. A lot of times we hear on the news about volatility. We don't hear so much about the good days. And sometimes, fear leads to more fear. But I want to emphasize that volatility is normal. On average, stocks are up about 9% per year, and the average pullback in the year is an average of 14%. Also consider the average max drawdown in a positive year for the S&P 500 is 11%. Last year in 2021, if you take a look right here, the S&P 500 index max drawdown was only 5%. This year, it's 13.9, right in line with the long-term average max drawdown of just over 14% as of this presentation, April 29th, 2022. Now, lower valuations have historically been followed by more attractive long-term returns for stocks, and vice versa. Based on this relationship, mid-single-digit gains for the S&P 500 index are reasonable to expect over the next decade. Now, the March and April correction pulled the index S&P 500 to the next 12 months price-to-earning ratio is down from over 21 to below 18. Okay? Again, I'm going to go back to saying that the key is really just to stay invested. Don't let fear and emotions dictate what you do. Similar to the relationship between stock valuations and subsequent performance, bond yields have historically been one of the predictors of long-term returns for bonds. The recent backup in yields is an indicator of the potential for investors to achieve higher long-term returns on bond portfolios. Earnings have grown nicely over the long term, growing an average rate of about 7.6% since World War II, based on the S&P 500 index. Now, earnings growth has supported stock market gains over the long term. Take a look at the chart. Now, if we take a look back at history, higher stock prices have tended to accompany rising interest rates with regards to the past. Now, looking at the periods of more than 100 basis points increases, excuse me, or 1% in the U.S. 10-year yield, the S&P 500 had averaged a gain of 18.4%. Giving you time to, take a look at this chart here. Now, during an average time, that 18.4% was during an average time period of about 27 months. Rates rose an average of 300 basis points during the periods in this study. The exceptions were that stocks fell as rates rose were the early 1970s, 1983 to 84, and then again 1993 to 1994. Next slide, please. Now, stocks have historically fared way better or well after the first Fed rate hikes of an economic cycle. On average, over the past 7 rate hike cycles, well, that's a tongue twister, going back to 1987, the S&P 500 has gained an average of 10% during the 12 months following the first rate hike. The one cycle where index fell over that 12-month period was 1987. Right here. The volatility around the shift in monetary policy tends to come immediately after the initial rate hike. Now, kind of extending the exercise on the prior slide, this table shows how stocks have historically done over entire Fed rate hiking cycles. On an annual basis, the S&P 500 has risen 4% during the Fed rate hike cycle since World War II. Here you can see that average here. Stocks rose during 8 out of 11 of these cycles based on the S&P 500 index. Next slide. Now, rebounds from big early year declines are common. After the worst starts to a year for the S&P 500 index ever, including its predecessor S&P 90 index, the rest of the year performance has been positive 67% of the time with an average gain of 10%. Next slide, please. Again, pullbacks are normal. On average, the S&P 500 index pulls back about 5% or more 3 times per year. Corrections are fairly common. On average, the S&P 500 index pulls back 10% or more once per year. This year through May 2nd, the S&P 500 experienced 2 10% or more corrections. One 13% starting January 3rd, 2022, and one 10% starting on March 29th, 2022. Again, for purposes of this presentation, all information has been pulled from April 29, 2022. Now, stocks have historically been resilient to geographical shocks. Historically, stocks have fallen an average of about 6% following the series of events listed on this slide. So we can take a quick look here, go ahead and take a snapshot if you'd like to look at it later, or a screenshot if you will. It has historically taken just 22 calendar years on average for the S&P 500 to bottom following these events, and an average of 48 days to recover from those losses. These are important things I want people to remember because, again, the media, fear, they just enrage more emotions. And again, we don't always make the best decisions when we get emotionally too involved. So this way, I want to bring people back and just kind of give them some context of various situations in the past. Now, stocks have fallen more following Russia's invasion of Ukraine, about 10% peak. But based on the human and economic impact of some of these tragic events, we do believe stock market performance will hold up relatively well as a result of the Russian and Ukraine conflict. Next slide, please. Bear markets have historically recovered fairly quickly when not accompanied by a recession. Now, on average, bear markets without recessions recover losses in just 10 months. Recessionary bear markets take an average of about 27 months to recover losses. As of right now, LPL Research does not expect a recession in 2022. However, if the S&P 500 enters a bear market and the team is right with its economic growth forecast for the year, the recovery could be fairly quick. I hope you enjoyed this presentation. Again, some key takeaways really is that there are normal inter-year declines in what people would normally call good years and also bad years of the stock market. And one of the biggest points to kind of hit home here is to stay invested. Remember that slide that showed what happens if you miss, just a few of the best days of the stock market? Stock market's unpredictable. You really want to be in the market on those best days when they happen. Thank you for paying attention, and thank you for your time today. Again, all questions you can email bob@simplifiedwealth.com. Take care. Hope all is well, and hope you have a great day. Bye-bye.